Hello, everybody. It is Friday, the 11th of December, 2015, and this is Brian Shannon speaking from alphatrends.net. I hope you made it through this week okay. It was a tough week for equities, obviously. The S&P 500 lost 3.7%, Russell 2000 close to 5%. Oil continued to get slaughtered, and now we have the S&P 500 back in the negative column along with the Russell 2000, the semiconductors, the Dow. So we're seeing that this market is finding a lot of trouble still for the buyers to maintain any control for any period of time. So let's take a look first at oil because that's got everyone's attention. Oil continued to get slammed. Here's a monthly chart that we're looking at right now. It goes back to 1995, and you can see that the 2009 lows in here at about 32 and change are only about 10% below where we are right now. We've clearly been in a downtrend in oil. Here's a weekly chart. We can see, this action a little bit more clearly. That we started out the year with that, coming off of that big decline in the fourth quarter of last year, and now we're seeing that we are continuing in this pattern of lower highs and lower lows. So anyone's guess where oil bottoms out, but for now it remains guilty till proven innocent. It's in an uptrend, meaning, it's in a downtrend, meaning that there's no point trying to pick the bottom. Now, as far as equities go, this is where my real interest is, and I think most of you as well. The S&P 500 had been kind of in this range really for most of this year, and if we take a look, we're going to back it up just a little bit, and what I've got on here is actually a 2-day chart, meaning each candle represents 2 days. It just allows us to see it a little bit more carefully, closely rather. That way, instead of a 50-day moving average, because I have 2 days on here, I have a 25-day moving average. That equals a 50-day. The 50-period moving average with these 2 days is 100 days. And of course, the 100 period, when we have 2-day periods, would be the 200-day moving average. So when we take a look at that volume weighted average price year to date that we've been referencing, we can see that did try to hold here briefly this week, but we broke back down below it here today, and we are also below all these key moving averages, and these key moving averages are flattening out to declining. Now, the 50-day moving average is still advancing, but if you take a look at where we were 50 days ago, it was right around in this area. So that means that even if this market goes sideways next week, that 50-day moving average will continue to advance for most likely the next week or two as we get rid of this data. So just something to keep in mind. I think the bigger issue right now is the fact that we broke down so hard, and that now we have to look at this market. It was actually, coming into this week, I'd said that it seemed like things were going to be bullish in this market. So let's take a look at the 10-minute time frame. We'll just draw a line straight across. This is how we came into the market this week right here. So this is Monday. We gapped lower. We did not hold the key level that I was looking for, which was 207.5. I said that we were going to be concerned below 207.5. At that point, it broke down. It got below the declining 5-day moving average, and then this week we saw a couple of little rallies above the 5-day moving average, but the 5-day moving average was declining, which is why I was telling subscribers that we're guilty till proven innocent. We have a lot of mixed messages. I certainly was not expecting this type of sell-off today. I kind of thought we were going to drift around a little bit in this area, but obviously the market doesn't care what I think. Our job is not to dictate our opinions to the market, but listen to the message that the market tells us. So for today, we gapped lower. We were briefly above that volume weighted average price, and we can look at a 1-minute chart for that. We were briefly above that volume weighted average price here this morning, and then we continued to close right down near those lows. So going into next week, again, we're guilty till proven innocent in here. Now, is it possible we'll get a bounce perhaps up towards this level? Absolutely. But it's guilty till proven innocent. We just don't want to take those chances. I think that's what's more likely than getting a bounce from this particular level is that we come down towards this 200 level. Now, there's a couple reasons for that. One, we had support back here in February, and then it became resistance after the August sell-off. And then it became support once again. So it's obviously a round number, and that there's a lot of psychological support associated with that. But also, if we take a look at the volume weighted average price from this October low, you can see here that it comes in right at that level. So here's our volume weighted average price from that level, just below $200 in the S&P 500. What we broke through today was the volume weighted average price from the September lows, and that had been support, as we can see right here on the more recent pullback. But now we have a lower high and a lower low here. So we have to express extreme caution in this market. Once again, since the August low, there's the volume weighted average price. We could also take a look at from that August low to the recent high, and I didn't draw that properly, but you can see it comes in approximately a 38.2% retracement. Let's just redraw that again, going from the lows to this bounce high, and you can see we'll then add that VWAP right back on there. So that tells us that this is an area of interest. If you saw my blog post on Alpha Trends this week about I showed a picture of the Unabomber, and some people thought that was strange. Why show a picture of the Unabomber? And the point was that I remember when the Unabomber was first they came out with that sketch, he was a person of interest. And like any investigation into a criminal, they have a person of interest. They build their case, and then they decide whether or not that case is strong enough to press charges and bring to a jury so that the DA can get the desired outcome of charging that person and having them guilty with the crime. So what's the point of that with the market, you ask? Well, this is in this area because we have a 38.2% retracement, because we have a volume weighted average price from this very important event, and because we have this prior level being support and resistance. That tells us that there's a lot of price memory in that area. So it becomes an area of interest to us. It's an area of potential support. We don't know if it will be support, but if it gets down there and begins to stabilize on shorter term timeframes, we start to build our case that perhaps the buyers will in fact regain control in that area. So if we took a look at that, let's just kind of draw that in a little bit here. And why am I having a, hold on one moment. Okay, I'm back. I've got it figured out. What I wanted to do was take a look on this 10-minute time frame and say, okay, now what's the scenario we would be looking for? We would be looking for the possibility that it maybe comes down into this area. We don't want to buy when it gets there. That's just playing guessing games. What we want to do is we want to see maybe it continues down below that level, comes back up and begins to turn sideways, and then the buyers regain control. Then we can get involved. But for now, it's an area of interest, nothing more. It's a potential level of support, nothing more than that. There's nothing, anyone who tells you there's support at 200 is just making stuff up. We don't know if there will be support there. That's an area of interest that we're going to look at closely next week. Now, again, as I was pointing out last week, what's your time frame is a very important piece of the puzzle. I came into the week saying I thought that the most likely scenario is we were going to rebuild and break higher, but as the market gives us new information, we have to be listening to that. And that's why if you just listen once a week, things change rapidly. We saw, again, the S&P lost 3.7% this week. Oil was down another 11%. Financials down 5.5%. So we've got a rapidly changing market, and it's a great environment for trading. Investors must be super frustrated this year, I would think, especially with the S&P now down 1.7%. That doesn't include dividends, of course, so keep that in mind that the dividends probably make it closer to break even. But let's take a look at the Nasdaq now. The Nasdaq, for its part, it's obviously been the healthier market. What we had seen just a couple weeks ago was that this breakout failed. We had a quick move lower. It looked like it wanted to recover coming into this week, and this was the beginning of the week. But instead, what did we see? We saw that this band of support once again failed, and now we're continuing lower. So when we back it up to the daily time frame, yes, we still have that rising 50-day moving average, and we've got the volume weighted average price from the August lows right down, down at whatever, what is this level? About 107.5. We've got a volume weighted average price from the September lows that are maybe going to be a little bit more important. So this would become, to me, for next week in the Nasdaq, this would become the potential area of support that I would be looking at as a level of interest. It would not mean that I would be looking to buy there, of course, but we've got the volume weighted average price from that low. And if that's the important volume weighted average price, then we could take a look at the Fibonacci off of that level and see that a 38.2% retracement comes in right here at this level at about 109-ish. So the bottom line is going into next week, we have these markets, all of them are below declining 5-day moving averages, meaning that if they get a bounce, expect it to be a bounce. That is, it would most likely encounter resistance up in this area. Now, it might just run right through that. So again, I wouldn't want to short just on a rally up towards that level. I would say that's an area of interest that if it bounces up towards that and then begins to come back down, then I would want to be short with a stop just above whatever the most recent relevant high is. So we take a look at the time frame we're looking at and say, where will the next lower high be? As the market begins to turn back lower, then we get short with a stop above that high, so that if it turns into a reversal, we're not up here wondering what the heck happened. We take our loss, accept that it was a small loss and the market didn't agree with us, and that's what trading is all about. It's not about being right all the time. It's about making money. It's not about saying, hey, I was bullish this week and I was wrong because the market went down. It's how you adapt to what the market gives you that's more important than labeling yourself as bullish or bearish. We're in a bearish environment right now. This week it was a bearish environment for stocks. The Russell 2000 had the potential to find support in this area. That's the level that we were looking at, saying, it's come down. And as I said to subscribers, I said, we don't want to sell in this area right here. Now that we didn't want to sell short down at 114 on Thursday. Instead, I said, it's down too much to really make it a low risk, high probability short. I said, we've got a clear pattern of lower highs and lower lows here. So we certainly don't want to buy it. But where has it come from? It had just come from 120 down to 114. And where did it have the potential to go before it was likely to find support? And I thought that was right there. So to me, it didn't make for a good risk reward ratio to be short. It also didn't make for a good risk reward to be buying long, because we still had a downtrend. So sometimes cash is the best position if you're not already in a position. So, I certainly wouldn't suggest that anyone, sell short down here. But if we get, perhaps a rally back up towards this level, once again, what we want to do is we don't want to sell short up there. But if it finds resistance and turns back lower, well, then you short somewhere in this area with a stop above the most recent relevant lower high. That's the way you want to look at the market for the time frame that you engage the market on. And that, of course, is entirely up to you. Now, if we back up this Russell 2000 to a weekly time frame, we start to get a little bit more concerned, because you can see that we came up to the 200-day moving average, and that failed to it failed to break through that level. What we were talking about was the volume weighted average price from January. That failed to hold. So let's take a look at that again over here on this 2-day chart. If we take a look at the volume weighted average price year to date, what we had said a couple weeks ago is we don't want to be the person who buys this so-called breakout beyond this little resistance here, because it had already traveled too far too fast. At the same time, we don't want to, if we want to short, we want to short as the market begins to turn lower. We don't want to short after this has already come down here. So perhaps we get a bounce in this, but the Russell 2000 is very concerning at this point to me, that we've got the we've got all these moving averages that were trapped below, longer term moving averages, and it appears as though this market could be the bigger area of trouble. Now, if we get a bounce, I would think that maybe a flush out, we go down something like this, then we bounce up towards this area in here, maybe even hold on into the end of the year, and then perhaps we get a bigger decline. I'm not here to predict. I'm here to anticipate where the potential potential levels of interest are, and when does it make sense from a risk reward standpoint to get involved. That's what I view my job as. The semiconductors pulled back to their rising 50-day moving average. There's potential that we can find support in here. The volume weighted average price from the August low and the September low, what one looks more important to you? What one looks more relevant? Well, the relevant one is, I think, off of the September low, because we had seen that hold as support once already. So perhaps we continue down towards this level. We've got a 50-day moving average which is rising, and a rising 50-day moving average tends to act as support. It doesn't mean it will. It means there's an area where we want to take a look at the market a little bit more closely on the shorter term time frame and say, is there actual evidence that the buyers are regaining control? And we're looking at a 30-minute time frame, and I see no such evidence. I see a market that's making lower highs and lower lows below a declining 5-day moving average. So I don't want to be a buyer in here. Is this low, the volume weighted average price from there, is that now going to act as resistance? We had this 55-ish level that was supposed to be holding as support, the potential area of support, but we didn't get it. So now is that going to be resistance? Well, it's guilty till proven innocent, and you don't want to sell short after a decline, but after a bounce within a decline, if the risk reward makes sense for your time frame. The biotechs, this group is still looking pretty darn ugly on the weekly chart, and this one as well is one that we've been talking about, that that volume weighted average price year to date, we had gotten above it very briefly 2 weeks ago, and from that failed breakout right over in here, so I miscircled it, but from that failed breakout a couple weeks ago, we've had then a break of support right in here. That was the level that we were looking to see if it would hold as support, and now we're down to the next important level where we've tested already, and there's no saying that this will hold as support. Very similar, actually, I think, to the Russell 2000. The Russell 2000, before today, this looked like it was going to be the level where the market began to stabilize. If you want to be a bettor, you can bet on that, and sometimes you're going to be right, but to me, it's not worth the risk. Go back to the biotechs. This is supposed to be the area where it's going to find support. This is where people will say it has support. Well, so far it does, but what is, because it hasn't broken below it. And you can point to the fact that it was prior resistance and prior support. To me, that just means if it breaks down from there, it's going to be more significant as resistance as it comes back up, and then we see a bigger decline. These markets are in trouble right now. Now, if somehow the biotechs gap up and they run up to here and find support in this area, then it can change. But right now, does that seem realistic? It doesn't to me. So I'm not looking for the bullish case here. I'm not looking for the bearish case. I'm looking at what are the key levels to be aware of, and is there enough potential reward for what I perceive to be the risk? Apple, the volume weighted average price year to date, we had gotten back above here a couple weeks ago on that earnings report, and we've been struggling with it since. In fact, that volume weighted average price year to date has been acting as resistance. Apple is a broken stock. It's below this prior band of support. That support had become resistance. Now we've got this trend line that's kind of trying to stabilize in here, and this trend line has been more of a band of support in this general area. People like to draw a trend line, with a straight line, but it's been that kind of area. So now so does that mean you buy Apple? Absolutely not. What's the trend in Apple? The intermediate term trend is clearly lower highs and lower lows below a declining 5-day moving average. Stay away from Apple. There's no reason to be a buyer of Apple. It's below the 50, the 100, the 150, the 200-day moving average. You look at the weekly time frame, maybe this is just a bigger consolidation, but certainly this is better a chance as the sellers have had to gain control the way they did over here, very similar to this level, than it has in the last several years, as we're now below all these declining moving averages. We're not here to make predictions. We're here to say, do I want to own this stock right now? Absolutely not. Let it recover. It's going to take time. Stocks correct either price-wise or time-wise, and we simply don't have enough evidence that Apple's making any attempt at a turn. Amazon was down a bunch of points today. That got a lot of press, but look at the trend in Amazon. It's been massive. It's still showing a pattern of higher highs and higher lows. I mean, Amazon rather could come down to 600 and then continue this uptrend. What's your time frame? For me, I certainly wouldn't want to buy it at 600 and 640 and see it come down to 600. I would feel like a dope if I did that. In fact, I would feel like a dope if I was holding this stock right now from an intermediate term standpoint, me personally, because it's broken support. It's below a declining 5-day moving average. I want to see it rally back up and make a higher high above a flat to rising 5-day moving average. And if I'm going to be a buyer right in this area as it does that, I want to say what's my most recent relevant higher low at that point. As it makes a higher high, then I want to raise my stop to the most recent relevant higher low. And in this case, for Amazon, that would mean you would be buying right in here and selling out right there at a loss. But is that better than continuing to hold it and have this much of a loss? To me, that is what makes sense, and that's what I talk about each day at Alpha Trends and in the classes that I teach. Facebook is pulling back here. It's coming down to a 38.2% retracement from the September low, and the volume weighted average price from that low is right in this area, which is also where we see that 50-day moving average. So in Facebook, do I want to be a buyer on weakness? Not personally, but this is a potential level of support, 38.2% retracement of this low to this high. So it's retraced 38.2%. It's the location of the rising 50-day moving average, and it's the approximate location of the volume weighted average price from that low. So here's an area of interest. That's what we're looking at. Gopro continues to be a dog. They had, one good day this week, and it's still in a horrific downtrend. Maybe it's the beginning of a bigger move, but we've still got declining moving averages. It's guilty till proven innocent. When you hear people say it's a short squeeze, that's not a short squeeze, not a structural short squeeze, because the shorts are still in control while it's in a downtrend. If the shorts were to have problems, I think those problems would really begin to develop maybe back above 20 and a half-ish. But right now it's still guilty till proven innocent. We spoke about Twitter last week and how the pressure was building on that. And Twitter did break down from that 25 level and made it down to 23 and a half. So there was opportunity on the short side, but look at where we basically closed unchanged in Twitter this week. If we go back to the 27th, let's just draw a horizontal line here on this one on Twitter. Here's where we closed, and now we'll draw that was a vertical line, not horizontal, and we actually closed lower in Twitter for the week, which is just crazy. There was opportunity obviously for shorts, and there was opportunity for longs. But the bottom line is Twitter remains in a longer term downtrend. When you look at that weekly chart, there's just no reason to be a buyer of stocks in downtrends unless you're trading for very short term periods of time.